Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of just to let you know what's going on out there. S&P 500 has had a very rough week. We're at about 3650 for the S&P as a level. That's down about 23% for the year. So still hanging out in bear market territory, as we talked about the last time we shot one of these video updates. That's down. You can add about 1% to that as a dividend yield since we're about halfway through the year. So rough math, we're down about 22% for the year. Obviously, those are tough returns, and it has been a very volatile market over the course of the past few weeks, really. The VIX, which is an indicator of volatility, is up around 32, 33, which is pretty high for that particular indicator. One of our advisors came to me the other day and basically said, look, it feels a little bit different. Why does this feel, it feels more scary out there, or people are more scared than they have been in quite some time. And the comment that I would just make is, one, people always fear the unknown, whether it's, we haven't really seen this type of inflation combined with economic uncertainty, or really inflation, since the 1970s. And really the last two recessions that we had, which were combined with inflation, were 76 and 78. So unless you were, really just beginning your investing career 40 plus years ago, you probably haven't seen this before. And there are certainly a lot of us that are out there in our 40s and 50s for whom this particular market environment is somewhat new. And for those individuals, the unknown or the uncertainty is scary, and fear breeds volatility. It breeds a whole host of other different behaviors that I think you're seeing manifested in the marketplace. The thing that I'd just like to point out a little bit is that there's a lot of talk going on about inflation and inflation pressures, and potentially combining those inflation pressures with some sort of recession that I feel like is a little bit forest for the trees. In the sense that, most of the market weakness that we've seen year to date has been a result of recalibrating valuations in light of interest rates that are moving higher. So interest rates going from sort of sub 1% to plus or minus 4% on the 10-year Treasury. That's a very significant interest rate move, and as a result, we've seen multiples on the S&P 500, or the trading valuation of the S&P 500. Move from a high of sort of 22, 23 times forward earnings down to sort of the mid-teens, which is a much more reasonable level given higher interest rates. And that all makes sense. It's mathematically demonstrated that, as interest rates move higher, equity market valuations start to move lower. What I think is a little bit more confusing for folks is this notion of higher interest rates when combined with the possibility of a recession. And there are certainly some folks out there that say, hey, the Fed is going to raise interest rates so far, so fast, they're going to have to, and that is going to kill off economic activity, and so we're going to get a recession. And the thing that I'd just like to point out to folks about that is that the best cure for high prices is high prices. In this case, if we were to see a recession as a result of the Fed raising interest rates too quickly, that generally means that people don't demand as many goods and services. If the unemployment rate starts to shoot up, if people start to spike their savings rates, et cetera, that generally means that they're not out there looking to buy new homes and new houses and new cars and new washing machines, whatever else other good is out there. And so as a result, we tend to see prices drop during a recession, which would reduce the pressure on the Fed to actually raise interest rates to try and curb inflation. So sort of a devil in one hand versus devil in another. If we were to actually see a recession, obviously that's bad from an overall macro standpoint, but it's very good from an interest rate standpoint. There have really only been two times in history, 1976 and 1978, when we saw recessions that continued apace in light of higher inflation. And in both those scenarios, the inflation was really driven by higher oil prices, which is the case today. But those higher oil prices were driven by either the Iranian Revolution or the OPEC embargo, the oil embargo. And in both cases, the U.S. was a massive importer of foreign oil, which is not really the case today. So I'm not exactly sure, if I put my macroeconomics hat on, whether or not those market conditions, whether or not there's a sufficient market condition out there to say, if the U.S. consumer went into a recession, whether or not those high oil prices would sort of maintain themselves, or whether or not we'd actually see lower oil prices as a result of globally lower demand, as well as just lower prices in general as a result of demand destruction. So I'm not necessarily sure that there's a lot of fear out there that I'm not necessarily sure is justified, in the sense that if you get a recession, you're likely to see inflation tamed itself down on the other side. The last thing that I would just say is a little bit on market timing. I know there are a lot of folks that are out there that are scared. I know that there are a lot of folks that are out there that are looking at their statements and they're concerned, and rightfully so. And we understand that. However, the thing that I would say about taking your money out of the market or making dramatic changes in your portfolios right now to sort of de-risk is that you've already missed 22% in terms of the downside. Generally, we try and construct portfolios that are intended to ride these things out. Normally, if you get out, you don't wind up getting back in until you start to feel better. And normally what feels better is seeing the market recover. And the sad part about that is that if you get out now and then you watch the market recover by 10 or 15% before you decide to get back in, you not only lost the amount in terms of that you locked in while you were waiting for it before you made the decision to get out, but you also lose the first part of the rebound. So, the hardest part about trying to be a market timer is not only just when to get out, but it's also when to get back in. And we just continue to encourage people to stay the course. Most of your portfolios were built to sort of withstand this type of market volatility. And while it's certainly not easy to look at what your statements say, it is something that was planned for when those portfolios were constructed. So, with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you have a great day, and I look forward to talking to you again soon.
Thank you for tuning in. And if you're enjoying this content, please subscribe to our YouTube channel and click the bell to be notified when we post more.